Welcome back, everyone. Ready to dive into another fascinating book.
Definitely. Always ready for a good deep dive.
So today we're cracking open The Psychology of Money by Morgan Housel. Have you had a chance to check it out?
Oh, yeah, definitely. Really insightful stuff. Makes you think about money in a whole new way.
Absolutely. It's not your typical finance book, is it?
Not at all.
Yeah.
It's more about, like, the human side of money, our emotions, biases, all that.
Right. Like how our psychology really influences how we handle money, sometimes for better, sometimes, well.
Yeah, sometimes not so much. Housel has some pretty crazy stories in there.
I know, like that tech executive who made a killing in the early days of
Mm.
Wi-Fi, but then
Oh, you mean the one who, like, smashed a lamp in a restaurant?
yeah, and then just threw thousands of dollars at the manager. Like, what?
Talk about bad financial decisions. But it's a great example of how even brilliant people can make terrible money
Right.
choices.
It's not always about intelligence, is it?
Nope. Housel actually contrasts that story with Ronald Reed, this Vermont janitor who quietly amassed an $8 million fortune.
Just by patiently saving and investing over decades, right?
Exactly. It really highlights the power of consistent habits over sheer intelligence when it comes to building wealth.
It's like the difference between knowing what to do and actually doing it consistently.
Totally. Housel argues that we haven't really applied scientific thinking to how we manage money.
We know what we should do, but actually doing it, well, that's a different story.
Absolutely. It's a whole different ballgame.
Mm.
Like with health, we've made huge strides thanks to science, but personal finance.
Yeah, it's still stuck in the past, relying on like willpower and outdated beliefs. Speaking of the past, one thing that really struck me was how much our early experiences shape our financial outlook.
It's like a financial fingerprint from our past.
Yeah, exactly. Housel highlights this research showing that our formative years have a huge impact on how we view money, even more so than education or intelligence.
There's this study by Malmendier and Nagel. They found that people who live through periods of high inflation, they tend to be more cautious with investments.
And on the flip side, people who experienced booming markets early on might be more comfortable with risk, even today.
Makes sense, right? It's like those experiences really stick with you.
It makes me wonder, like, is our financial psychology kind of set in stone based on our childhood?
I wouldn't say set in stone, but definitely influenced.
Yeah.
The key is awareness, right? Understanding how your past might be shaping your current financial decisions.
Makes sense. Like, maybe we should all take a moment to reflect on our own financial origin stories. I mean, I know growing up during a recession made me more cautious with spending.
It's about understanding that everyone comes to money with their own baggage, so to speak.
Right. Which leads to another great point Housel makes. Everyone approaches money with their own unique story, their own set of beliefs and experiences.
Totally. What seems crazy to one person might make perfect sense to someone else.
Like buying lottery tickets when you're struggling financially.
Exactly. Statistically terrible decision. But the emotional pull of that dream, it can outweigh logic. It's not always about spreadsheets and algorithms.
Have you ever made a financial decision that other people thought was nuts, but it made sense to you at the time?
Oh, yeah, definitely. I think we all have, right?
Yeah,
And it's about recognizing that everyone has their own story, their own reasons.
totally. Makes you approach things with a little more empathy for yourself and for others.
Absolute.
Now, this whole idea of never enough, even among the ultra wealthy, that really stood out to me.
Oh, yeah, that's a big one.
Housel tells that great anecdote from John Bogle about the author Joseph Heller and this billionaire, remember?
I think so. Remind me.
The billionaire's bragging about making more money in a day than Heller did from Catch-22.
Right, right. And Heller says, yeah, but I have something he'll never have. Enough.
Classic. It just shows that true wealth isn't just about accumulating money, right? It's about being content.
Yeah, finding that sense of satisfaction.
But then you have guys like Rajat Gupta, the former Goldman Sachs director, caught up in insider trading.
Hundreds of millions of dollars, and he still wanted more, risked it all.
It's a reminder that wealth doesn't always equal happiness. Sometimes it's the opposite.
Like Housel says, there's no reason to risk what you have and need for what you don't have and don't need.
Words to live by.
It's a good reminder to focus on what truly matters, right? Being grateful for what you already have.
So true. And that actually leads perfectly into this idea. Housel talks about the difference between getting wealthy and staying wealthy.
Oh, yeah, that's huge, right? It's one thing to make a fortune, but holding on to it, managing it wisely, that's a whole other skill set.
Totally. It's like Jesse Livermore, the famous stock trader. He made and lost multiple fortunes, right?
Yeah, Livermore, he was brilliant, but he lacked the discipline.
The emotional control to actually keep his wealth.
Exactly. He was always chasing the next big win, and it ultimately led to his downfall.
Makes you wonder if there's a certain personality type that's better suited to staying wealthy.
Well, Housel talks about this survival mentality, which sounds intense, but it's really about taking a long-term view.
So not like being a doomsayer, but more like being prepared for anything.
Exactly. Recognizing that financial markets are unpredictable and having a plan to weather the storms.
Makes sense. That reminds me of room for error, which Housel talks about a lot. What does that actually mean in a practical sense?
It's all about building in buffers and safeguards,
Right.
right? Protecting yourself from unexpected events.
So like having an emergency fund, not going crazy with debt diversifying investments, that kind of
You
thing.
got it. It's about not betting everything on a single hand because life can deal you a losing streak at any moment.
Love that analogy. It's so true. He also quotes Andy Grove, the former CEO of Intel, who said, "Only the paranoid survive." Seems a bit dramatic for personal finance, but
Yeah, but the point is to have a healthy respect for risk.
right.
Be prepared for the unexpected.
Complacency can be dangerous, especially in a world that's changing so fast.
I totally agree.
Okay, so we've talked about being prepared, having that survival mentality. But what about the flip side, the potential for growth? How do you balance caution with the desire to build wealth?
That's where the magic of compounding comes in. Housel does such a good job explaining this concept.
Remember that analogy with the ice ages? It seemed counterintuitive at first, but
But it makes total sense, right? Tiny changes compounded over time, massive impact.
yeah, just like a tiny shift in summer temperatures over centuries leads to huge ice formations. Small, consistent investments can snowball into major wealth.
The problem is our brains are wired for linear thinking, not exponential growth.
Hmm.
So we tend to underestimate the power of compounding.
We get impatient. We want to see results now.
Exactly. And that leads to short-sighted decisions. The key is to start early, stay consistent, let time work its magic.
Which brings us back to patience, right? It's a recurring theme in the book.
Patience is a virtue, especially with money. It's about resisting the urge for quick wins and focusing on the long game.
Speaking of things that take time, let's talk about those tail events Housel mentions. Those rare, unpredictable occurrences that can have a huge impact. Remember the example with Bill Gates and Lakeside School?
Oh yeah, how being at one of the few schools with a computer terminal back then shaped his entire trajectory.
Talk about being in the right place at the right time. But these tail events, they're not just about individual success stories. They can impact whole industries like venture capital.
Exactly. VCs know that most of their investments will fail. But a few big wins, those home runs, can make up for all the losses.
So even in a diversified portfolio, a few big winners can drive the majority of the returns.
Right. Research shows that the stock market is similar. A small percentage of companies generate most of the gains.
So how do we as individual investors navigate this world of tail events? It seems tricky.
Well, Housel talks about developing a barbelled personality when it comes to investing.
A barbelled personality. What's that?
Think of it as being optimistic about the future, but also paranoid about what could go wrong.
So like balancing hope with a healthy dose of skepticism?
Exactly. The market can be both incredibly rewarding and incredibly unforgiving.
Sounds stressful. How do you stay sane in a world where these tail events can make or break you?
Focus on what you can control.
Mhm.
You can't predict when the next tail event will happen, but you can control your risk exposure.
Diversify your investments, have a plan to weather the storms.
Right. Have that room for error we talked about.
Yeah.
It's about building in those buffers so you can stay in the game even when things get tough.
Okay, all this talk about risk and uncertainty, it makes me wonder about the rewards of wealth. And I don't just mean money in the bank. Housel talks about the highest dividend money pays. What's that all about?
He's talking about freedom and control over your time, right? It's not about material possessions or bragging rights.
It's about having the flexibility to pursue your passions, spend time with loved ones, make choices based on what truly matters.
Having the freedom to say no to things you don't want to do and yes to the things that bring you joy.
You know what? It reminds me of when I used to work as a valet. I was so focused on those fancy cars, thinking they were the ultimate sign of success. But I rarely paid attention to the drivers themselves.
That's the man in the car paradox Housel talks about. We strive for wealth to impress others, but those others might be so busy comparing themselves that they don't even notice us.
It's like we're all caught in this game of keeping up with the Joneses, forgetting what truly matters.
Housel's advice: focus on building wealth that gives you control over your time, not just material possessions.
So instead of buying that fancy car to impress the neighbors, maybe invest in a trip with loved ones or take a class to learn something new.
Exactly. Those are investments that pay lasting dividends. It ties into his point about wealth being what you don't see.
What do you mean by that?
Think about it. Wealth isn't about how much you spend, it's about how much you save and invest. It's about accumulating assets that give you options and flexibility.
It's like that saying, wealth whispers, it doesn't shout. It's the quiet confidence of knowing you're financially secure.
Exactly. And this leads us to another key concept, being reasonable rather than strictly rational with money.
What's the difference?
Being rational implies making decisions based purely on logic and data.
Huh.
But we're humans driven by emotions and biases.
So trying to be perfectly rational with money, it's like trying to fit a square peg in a round hole.
Exactly. Housel argues that rigidly sticking to a rational financial plan can backfire if it doesn't account for our humanness.
It reminds me of that story about Julius Wagner-Jarrag, the doctor who won a Nobel Prize for using fever therapy to treat syphilis.
Oh yeah, inducing fever in patients sounds crazy, right?
Totally. But it worked.
Sometimes the most effective solutions aren't the most comfortable or the ones that make immediate sense.
So how does this apply to investing?
Sometimes rigidly sticking to a rational investment strategy can create a lot of stress and anxiety. It's about finding a balance.
A balance between what's optimal on paper and what's actually sustainable for you in real life.
Right. Remember, Housel talks about Harry Markowitz, the Nobel laureate who developed modern portfolio theory.
Which is like the cornerstone of rational investing.
And even Markowitz admitted that he didn't follow his own theory for his personal investments. He opted for a simpler, more reasonable approach.
That's kind of comforting to know. Even the top minds in finance recognize that we're human.
It's about finding a strategy that you can stick with over the long haul.
Housel says it's better to love your imperfect strategy than to abandon a perfectly rational one because it's too difficult or emotionally draining.
Right. Consistency is key.
So the takeaway: find a balance between data-driven decision-making and self-awareness.
Use data and analysis, but also recognize that you're human, with emotions, biases, and a unique set of circumstances. It really is.
You know, another thing that stood out to me about the book, it's how Housel talks about pessimism, especially when it comes to money.
Yeah, that's interesting. You'd think with all the progress and innovation we see, people would be more optimistic about the future.
Right. But Housel argues that pessimism can be seductive. Like it sounds more intelligent somehow, especially in the world of finance. It's easier to criticize and predict doom than to imagine a positive outcome.
Totally. It plays on our fears. It's more attention-grabbing. You know what I mean?
It reminds me of that Russian professor who was all over the news back in 2008 predicting the collapse of the U.S. economy.
Oh, yeah. What was his name?
I can't remember. But his prediction was totally wrong, yet it made headlines everywhere.
Exactly. Pessimism grabs our attention. Because it's dramatic, it taps into our anxieties.
So how do we as investors avoid getting sucked into that negativity spiral?
Housel suggests a balanced approach. Be aware of the risks, of course. But don't let pessimism blind you to the opportunities.
Don't forget about the potential for growth and progress.
Right. Pessimism can become a self-fulfilling prophecy. If you're constantly expecting the worst, you might miss out on great opportunities.
It's like that Henry Ford quote, whether you think you can or you think you can't, or you're right. Your mindset really does matter.
It really does. And this ties into another important point Housel makes. We have this tendency to over-rely on historical data.
Especially when it comes to investing, right? We look at past market trends and assume they'll just repeat themselves.
It's tempting to think that way. But the world is constantly changing. What worked in the past might not work in the future.
Housel calls this the historians as prophets fallacy.
It's a fallacy because the world is full of surprises.
He emphasizes the importance of recognizing structural shifts. You know, like those fundamental changes that disrupt the old ways of doing things.
Exactly. Take retirement planning, for example. The rise of 401ks and Roth IRAs has completely transformed the landscape.
You can't predict retirement savings today based on data from the era of pensions, right?
It just wouldn't make sense.
Yeah.
And the same applies to the stock market. The explosion of venture capital tech startups, it's created a whole new paradigm.
So how do we make informed financial decisions in a world that's constantly evolving?
Housel encourages us to become more comfortable with
To
uncertainty.
expect the unexpected.
He actually quotes Daniel Kahneman, the Nobel laureate, who said that whenever we're surprised by something, we tend to say, oh, I'll never make that mistake again. But in reality, what we should learn is that the world is incredibly difficult to predict.
Instead of beating ourselves up over missed predictions, maybe we should focus on becoming more adaptable, more resilient.
Exactly. The best investors are those who can adjust their strategies when things don't go according to plan.
They've got that room for error built in, not just financially, but mentally too.
They have the mental toughness to stay focused on the long game, even when things get chaotic.
This has been such an eye-opening conversation. I feel like I'm looking at money in a whole new light.
Me too. It's been great diving into this book with you.
So to wrap things up, what are some key takeaways from The Psychology of Money that our listeners should remember?
Well, first off, remember that financial success is more about behavior than intelligence. It's about developing those consistent habits.
Right. It's not always about being the smartest person in the room. It's
Mhm.
about making smart choices consistently.
And everyone approaches money with their own unique story shaped by their experiences, their beliefs. Don't judge others for their financial choices.
And be kind to yourself when you make mistakes. We all do.
Absolutely. Patience is key as well.
Yeah.
The power of compounding is incredible, but it takes time.
Start investing early, even small amounts, and let time work its magic.
And finally, be prepared for the unexpected. Expect surprises. Embrace change. Have that room for error built into your plans.
Love that. Great advice. Well, this has been a fantastic deep dive into the psychology of money. Thank you so much for joining me.
It's been a pleasure. Always happy to talk about this stuff.
We hope you found this conversation valuable and insightful. As always, thanks for listening and happy investing.